Hey everyone, we're Group 5 and we're going to be presenting on Costco and ConocoPhillips.
We will begin with the Porter's Five Forces and their strategies, and we'll first start with Costco. We will begin with the competitive rivalry. Costco is the top competitor in the retail industry. Costco has a strong competitive rivalry against their competition. This means that there is a lot of competing firms in this industry, a high variety of firms, low switching costs. Costco's biggest competitors include Walmart, Target, and Sam's Club.
Costco's strategy for competitive rivalry is cost leadership. Since the industry has a strong force in competitive rivalry, they need to constantly be aware of their competitors. Their strategy entails selling more for less. Costco buys and sells things in bulk, which means when products is sold, more is moved per purchase at a lower cost than their other competitors.
We believe the bargaining power of buyers is a strong force for Costco, which considers the influence of customers on the firm's effectiveness in the industry. Costco has a great deal of substitutes and low switching costs. For instance, Costco customers can easily go to other retail stores such as Walmart, Sam's Club, or even online.
The strategy for Costco is to create a great shopping experience and great prices. Costco has developed a large paid membership base along with a loyal and helpful workforce. It's possible that Costco shoppers are so convinced they are better off by its services that they are willing to pay for the privilege of entering the store.
Costco's bargaining power of suppliers is a weak force. There isn't a single supplier that can easily impose its demands on a firm like Costco because they're so large, and which means that Costco gets to choose from the suppliers that they want to deal with. There's also a low forward integration, giving suppliers minimal control on the distribution and sale of their products, giving Costco full control.
The strategy that Costco uses to keep the bargaining power of suppliers low is to keep a large population of suppliers and a high overall supply. For example, the actions of a single supplier would not affect the company.
The threat of substitutes is a strong force for Costco and is one of their biggest challenges. High availability of substitutes, high performance to price ratio of substitutes, and low switching costs are all factors. Customers can use substitutes to satisfy their needs.
Costco's strategy for fighting substitutes includes keeping prices low using cost leadership, creating a better shopping environment, stocking and selling popular items, and creating incentives for members. Keeping a positive image with their brand name is very important for the company.
The threat of new entry is of a moderate force for Costco. New entrants in the retail industry are consistently affecting the market's environment. Low switching costs can pose a threat to Costco, allowing consumers to shop elsewhere. But the moderate cost of doing business and high economies of scale make it harder for new entrants to succeed.
Costco's leadership for new entrances is to rely on economies of scale and constantly being aware of the up-and-coming businesses and trends that pose a threat to their company and business model. They also focus on remaining one of the leading cost leadership businesses.
Now we will go over ConocoPhillips. Rivalry among existing firms, the risk level is high. They have many competitors, ExxonMobil, Chevron, just being a few of them. Consumers don't have much brand loyalty towards any one of these companies. There is also little differentiation between the products of the companies.
The strategy for rivalry among existing firms is ConocoPhillips is implementing a cost leadership strategy to address the high level of competition within the industry.
Bargaining power of buyers' risk level is high. There are more buyers than there are sellers in this market. Switching costs are low for the buyers because the product is not differentiated a lot from other companies in this industry. There are substitute products available, which also gives the buyers more power.
To address the bargaining power of buyers, ConocoPhillips has implemented a cost leadership strategy. Because there's little differentiation in the product within the industry, the main strategy here is to get lower prices compared to the other firms within the industry.
Bargaining power of suppliers' risk level is low. The product is not differentiated from others in the market, making the supplier have little power. There is relatively no switching cost for the buyer, taking more power away from the supplier.
To address the bargaining power of suppliers, ConocoPhillips needs to ensure that their buyers are happy with their prices and the services that they receive, because their buyers can go wherever they want for their product.
Threat of substitute products risk level is high. Many companies are going green and are trying to use solar or other environmentally safe forms of energy. People are also buying transportation and buying electric cars because it will save them money in the long run. People also can walk or ride bikes instead of buying oil or other natural resources.
To address the threat of substitutes, ConocoPhillips is, as earlier stated, is investing 12% of that $11.2 billion into their refining processes, and this will help them find those safer and more efficient forms of energy, and it'll help them gain a better competitive advantage.
Threat of new entrants, risk level is low. There's a lot of government regulations that companies in this industry have to deal with. You also have expensive technology to retrieve the resources needed. And bigger companies in this industry make it hard for little companies to start up, even though there's not a lot of differentiation between the products.
The strategy to address the threat of new entrants is ConocoPhillips has implemented a capital funding program in 2010, $11.2 billion, and 86% of that money is going to go towards exploration and production, which will increase the technology and the valuable resources that they possess, which will make it harder for new entrants to enter the industry.
I will introduce both of companies' revenue structure. The first table is Costco's revenue by regions. We can see Costco revenue that comes for three parts. They are US, Canada, and other international. We can find that US is main part that revenues comes for Costco by ratio. Second table is about ConocoPhillips. Their revenue structure is contributed by 8 parts. Alaska, lower 48, that means contiguous United States, Canada, Europe, and North Africa, Asia Pacific, and Middle East. Other international and corporate and other. The most revenue comes from lower 48. Another point that I found is revenue of international part for ConocoPhillips. For this part, we can find that from it decreased every year, and from 2013 to 2014, the revenue became almost 0%. Next, I will introduce Costco revenue by product. We can see there are 8 parts for 3 table. In 2016, the main revenue resource is food for Costco. Second is sundries. Third is hardlines. Fourth is others. Fifth is fresh foods. And sixth is soft lines. And the final came from memberships. These are specific construction of Costco revenue. This couple of years, the last table is from ConocoPhillips. The main revenue of company are from sales and other operating revenues.
Costco's revenue recognition is primarily on a sales basis method, where they don't recognize any revenue until the customer has paid for the product and has received that product. They value their inventory in 2 ways. In their U.S. operations, they use the LIFO method, which shows ending inventory on the balance sheet at a lower cost than what the inventory is worth at the current price. In their foreign operations, they value their inventory using FIFO, which gives a more accurate ending inventory amount, but it does increase the amount of net income. They have very little allowance for bad debt, where they don't lend out credit. This is to be expected. In fact, for the past 4 years, in their annual report, they just determined that the allowance for bad debt was immaterial and didn't even assign it a dollar amount. They do have a little bit of off-balance sheet debt. About a 7-year average was just under $4 billion at $3.9 billion. ConocoPhillips uses a similar revenue recognition system of the sales basis where nothing is recorded until the customer has both paid for the product and taken possession of the product. They value their inventory at LIFO, which, as mentioned with Costco, shows the ending inventory amount on the balance sheet lower than what the current price is, which results in a lower net income because the cost of goods sold is a higher amount. They do have a little bit of an allowance for bad debt. 6-year average was about 0.15%. Not a lot, where similar to Costco, they're not lending credit to a lot of customers, so they are collecting on a lot of their amounts. The off-balance sheet debt is significantly higher than Costco's. They had for a 6-year average of $21.9 billion of off-balance sheet debt.
The earning per share ratio measures the income available for common stocks on a per share basis and is examined nearly all statement users. The graph shows Costco's earning per share ratio from 2012 to 2016. It just has great increase all the way. But look at the ConocoPhillips in last 2 years, 2015 and 2016, it just decreased to minus. It because of some strategies problem. Look at the price earning ratio, which is P ratio, is the ratio for valuing a company that measures its current share price relative to its per share earnings. Investor would like to invest in Costco because the company price earning ratios has been maintained at a relatively good level, although the ratio increased from 24.84 to 30.55 during 2012 to 2016, but it's still a good, nice level, which means that investor can still get more profits in the future. I believe the Costco will attract more investors. But look about ConocoPhillips. Investor might need to think about, is it worth to invest in this company? Because the company price earning ratio has been to minus level also in 2015 and 2016. From the data also can get a fact market value per share decreased a lot.
Over the last 5 years, between Costco and ConocoPhillips has had a really unstable stock. About 5 years ago, they were trading around $75, and through ups and downs, they reached a peak of $95. But today, they are trading around $50, and they've been really unsteady. Costco, on the other hand, has had very gradual growth over the last 5 years. 5 years ago, they were trading at $85 a share, and today they're around $170 a share, which is around a 20% 20% growth per year, which is phenomenal, and it's consistently been that way for the last 5 years. Through our vertical analysis of the two companies, Costco and ConocoPhillips, in the income statement, we found trends within the different areas of income. And for ConocoPhillips, we can reasonably estimate that based on the past trends in their financials and where we think the company is going, that they will again have a negative net income. This will be around negative $3 billion or $3,697,000,000. And based on their last year's shares outstanding of $1.782 billion, we can expect that they'll have a earnings per share of negative $2.0745, or in this case, a losings per share. And Costco, on the other hand, has had a gradual growth in all theirs on the income statement. And through the vertical analysis, we can reasonably estimate that they will have a net income of $2.5 billion for 2017, which is up from $2.3 billion in 2016, and with the earnings or with the shares outstanding of around 434,366,000 shares, the earnings per share will be $5.77.85, which is up from 2016's earnings per share, which was $5.36 per share. For the executive compensation for these two companies, ConocoPhillips CEO Ryan Lance makes significantly more than those of their competitors. With the exception of Chevron, Ryan Lance makes about double what the nearest competing CEO makes. And for his salary, he makes $4.2 million base pay, and after incentives and different stock options, he makes just over $21 million a year. Costco, on the other hand, their CEO, Craig Jelinek, makes around $781,000 a year base, and after incentives, stock options, and rewards, makes just north of $6.5 million a year. This is substantially less than the other two competing CEOs of Walmart and Target, about half of each of those CEOs. Moving on to the financials between Costco and ConocoPhillips, we see that in the operating return on equity, Costco is much better. So over the last 5 years, they've been pretty staggered in the high teens, around as low as 13 up to 22% return on equity. And but on ConocoPhillips' end, they've been around 17% early in the last 5 years, but then have dropped into the negatives. As recently as 2016, they were negative 10% operating return on equity. The earnings per share for Costco have been growing steadily. At first, in 2012, they started at $3.94, and today they're at $5.36. As for ConocoPhillips, in 2012 they were at $6.77 cents per share, but now they are losing money, so they're at negative $2.91 earnings per share. On the gross profit margin between the two companies, Costco and ConocoPhillips, we find that for Costco, the gross profit margin has been around 10 to 11% steady for the last 5 years. As for ConocoPhillips, though, the gross profit margin has been in the high 50s, as low as 56% and to 57%. Moving on to the inventory turnover between Costco and ConocoPhillips, we see that this is where the financials are starting to be affected by the performance of the company. So within ConocoPhillips, we find that between 2012 and 2016, the inventory turns per year have started to decrease. For ConocoPhillips, it was 26 turns a year, and now it's only at 9. This shows that they're being more inefficient in the way they sell their products. Versus Costco, over the last 5 years, they've been pretty steady, around 10 to 11 turns per year. So this just shows that they're much more efficient than ConocoPhillips is at turning inventory. On the liabilities to equity ratio between Costco and ConocoPhillips, we find that the companies are becoming more leveraged as time goes on. For Costco, for example, at first they started at about 1.1 liabilities to equity, and now they're up into 1.7, and in 2015 they were at 2.2. This just shows that they're being more leveraged in order to have more capital to grow. And for ConocoPhillips, this has also been the case. They've gone from 1.4 and now they're up to about 1.5. This is just slight, but this may reflect their poor performance. They need to be leveraged somehow in order to stay in business. One thing we found interesting was the PE ratio between Costco and ConocoPhillips. For ConocoPhillips, we found that they started around PE ratio of 8, but then they have moved into the negatives. This reflects that the performance of the company, and this is so because the stock market has accurately represented the company itself. Costco is a completely different story. While Costco has been doing great, their PE ratio is astronomically high. This just means that the investor perception of Costco is a lot higher than the actual value that is being generated through their financials and through their performance. So this just shows that there may be a slight misunderstanding between Costco and the general public.
Based on the information, strategies, and financials presented of both companies, we have concluded that Costco is the best investment. This decision was made off of industry, revenue, and forecasts. In terms of industry, retail is more successful in cost leadership than natural resource. Oil is constantly fluctuating and unstable. Costco has a higher EPS and revenues than ConocoPhillips. They also have a positive forecast of 5.78 earnings per share compared to ConocoPhillips' negative forecast of negative 2.07 EPS. In conclusion, our research and forecasts strongly encourage us to invest in Costco.